Chapter 15, Investments. Companies often take the opportunity to invest in other companies. Sometimes the investment is as simple as taking advantage of an opportunity to invest for a short period of time and then sell the investment when profits can be realized. Other times, the investment is for strategic purposes, to form a relationship with another company, to expand horizontally or vertically, or to gain control of the other company. Investments are classified as either short-term or long-term based on the underlying reason for the investment. There are 5 basic ways to classify an investment. We have trading investments, held-to-maturity investments, available-for-sale investments, significant interest investments, and controlling interest investments. Trading securities are usually short-term investments in either equity or debt securities of other companies. They represent less than a 20% ownership of the company being invested in, at least for equity purposes, and are usually acquired for speculative purposes. Now, held-to-maturity investments are debt securities that are purchased to generate income. They are classified as short-term or long-term based on the maturity date of the debt. Available-for-sale securities are debt or equity securities that represent 20% or less of the outstanding equity of the investee company. They are usually considered long-term, but can be short-term. The investor usually does not have an immediate intention to sell the securities. The intent is usually to establish a financial relationship with the company that has a strategic relationship to the investor. Significant interest investments are investments in equity securities. They represent ownership that is sufficient to establish significant influence over the investee company. The number of equity shares owned usually represents somewhere between 20 and 50% of the outstanding voting stock of the investee company. And finally, controlling interest investments are investments in equity securities. They represent ownership that is sufficient to establish control over the investee company. This usually implies an ownership of at least 50%, or I guess slightly more than 50%, so 51% or 50.1% of the outstanding voting stock of the investee company. Take a look at this, try it, and just make sure you've got these terms down. When a company purchases debt securities of another company, the investment is recorded at cost at the time of the investment. While interest revenue will accrue on the investment, there is not interest recorded on the date of the investment. On July 1st, 2014, Smart Touch Learning invests $100,000 to buy bonds of Neon Company. The bonds carry a $100,000 face value and pay 9% interest over their 5-year life. Record the investment in bonds on July 1, 2014. Well, that would look like this. You're going to have a debit to long-term investments held to maturity for $100,000 and a credit to cash. On December 31st, 2014, 6 months have passed since making the investment in the bonds. Smart Touch Learning will receive their first interest payment on December 31st, 2014. Record that interest received on December 31st, 2014. And this is what that would look like. Smart Touch Learning is owed $4,500 in interest. You calculate that by taking the $100,000 face value of the bond, multiplied by the 9% interest rate, multiplied again by the fraction of the year that has gone by. In this case, that would be 6 out of 12, or 1/2, and that totals out to $4,500. Thus, the entry requires a debit to cash for $4,500 and a credit to interest revenue for $4,500. Jump forward to the maturity date of June 30th, 2019. The Neon Company bonds mature and Smart Touch Learning will receive back their original investment. Assume that the final interest payment has already been received and recorded. So all we're worried about is the actual maturity of the bonds. No extra interest to be recorded. Record the maturity of the bond investment at June 30th, 2019. Okay, since we're not worried about interest, we're only worried about basically clearing out that long-term investment there. So you'll have a credit to that long-term investment and a debit to cash for that amount. Equity investments that are less than 20% of the outstanding equity of the investee are accounted for as either trading securities or available for sale securities. For both of these types of investments, the original investment will be recorded at cost at the time of the investment. Any dividends received from those investments will be recorded as dividend revenue. The difference in accounting for the two types of securities is related to how changes in market value for the securities are recorded. On March 1st, 2014, Smart Touch Learning acquires 1,000 shares of stock in Yellow Corporation for $26.16 per share. This is an available for sale security. Record the acquisition of stock on March 1st, 2014. Well, again, this is going to look a lot like the previous examples we looked at. So it's going to be a debit to long-term investments available for sale for that amount, $26,160, which is just the cost per share times the number of shares, and a credit to cash for that amount. On May 17, 2014, Yellow Corporation declares a dividend of 16 cents per share to stockholders of record on March 17, 2014. Record the receipt of that dividend on June 9, 2014. Well, this is just going to be a simple debit to cash and credit to dividend revenue. And all we had to do to find the amount is multiply the 16 cents per share times the 1,000 shares that we had, and that gives us $160. On July 15, 2014, Smart Touch Learning sells 800 shares of its Yellow Corporation stock for $25,000. Record the sale of Yellow Corporation stock on July 15, 2014. Well, this here is the beginning of the entry. The entry requires a debit to cash for $25,000. However, the investment account must be credited only for the cost of the 800 shares that were sold. Because the original cost was $26.16 per share, we can calculate the cost of 800 shares sold as 800 times 26.16 per share. This gives us our credit here of $20,928 from long-term investments available for sale. A credit will be made for that amount to long-term investments available for sale. At this point, the journal entry does not yet balance. The difference will be recorded as either a gain or loss depending on what is needed to balance the journal entry. In this case, we need a credit to balance this journal entry. So, the amount received for the shares of $25,000 exceeds the cost of the shares sold of $20,928 by the amount of $4,072. This is recorded as a credit to gain on disposal of long-term investment for $4,072. When the level of the investment is between 20 and 50%, then a different accounting approach is required. At this level of ownership, it is assumed that the investing company has the ability to exercise significant influence over the investee company. The accounting requires the investment to be recorded at cost. Dividends received related to this investment will be recorded as a return of investment instead of a return on investment, and accordingly will be accounted for as a reduction to the investment account. In addition, the investor will increase the investment account for the investor's share of the investee's net income for the period. This approach is referred to as the equity method of accounting for investments. Let's take a look at an example. On January 6, 2014, SmartTouch Learning paid $400,000 to acquire 40% of the common stock of Klein Incorporated. Record the acquisition of the Klein Incorporated stock as of January 6, 2014. This is a simple debit to long-term investment and credit to cash for the amount, $400,000 that we're talking about. So, not much different at this point. However, moving on. On June 30th, 2014, SmartTouch Learning receives a dividend of $20,000 from Klein Incorporated. Record the receipt of dividends from Klein on June 30th, 2014. This is where it gets a little bit different. Of course, we're going to debit cash for the amount just like we would any other time. But now, instead of crediting dividend revenue, we are going to credit long-term investment. And that's the account we just debited in our last entry to show that we made this investment. So this looks exactly like we're actually getting some of the money we invested in this company back. And that's what it's supposed to look like. Okay? So we got a $20,000 debit to cash and a $20,000 credit to long-term investment. So whenever we are getting a dividend back, since we have so much control of the company, we are basically just treating that as if we're owners of the company, removing some of the money of the company and putting it in our pockets. On December 31st, 2014, Klein Inc. reports net income of $125,000. Remember that SmartTouch Learning owns 40% of the stock of Klein Inc. Now record SmartTouch Learning's share of Klein Inc.'s net income for 2014. Well, all we're going to do for that is we're going to take that 40%, multiply it by the $125,000 net income, and that is how much our investment account is going to go up. So you see here, that amount here comes out to $50,000. So again, long-term investment account is going up. That's the account that just went down when we got dividend money back. So now that account is going back up, and it's just recorded as revenue from investments. Now on January 1st, 2015, SmartTouch Learning sells 10% of Klein Inc. stock for $40,000. At this point, the long-term investment account for Klein Inc. is at $430,000. $43,000, 10% of that book value is being sold for $40,000, which turns out to be a loss of $3,000. Record the disposal of 10% of Klein Inc. investment on January 1, 2015. Well, we know we're getting a debit of $40,000 to cash, and we know that since we used 10% up of that long-term investment, and the book value of that was $43,000, those numbers are basically given to us. So in order to balance this entry, we know that we're going to have to put $3,000 on the debit side of this entry. So that will go into the account loss on disposal, and now our entry is balanced. And of course, if it had been the other way around and the $43,000 was in cash, the $40,000 in credit there, then we would have the opposite. We would have a $3,000 credit to gain on disposal. So whichever side needs it, that will reflect whether it's a loss or a gain on the disposal. And of course, knowing what the book value is versus what you receive should also tell you, hey, I gained on that transaction or I lost on that transaction. When investments exceed 50% ownership, the investor holds effective control over the investee. At this point, the investor is referred to as the parent company, and the investee is now referred to as a subsidiary company of the parent. At this point, the financial statements of the parent and subsidiary companies can no longer be treated as two independent companies. Instead, accounting rules, at least GAAP accounting rules, require that the financial statements of the two companies be reported as if they are only one company. Such combined statements are recorded as consolidated financial statements. The process for consolidating the financial statements for parent and subsidiary companies is actually quite complex. It involves making a series of adjustments to eliminate and adjust balances that would otherwise appear to be confusing if they appeared on the consolidated financial statements. Unless you're actually going into accounting as your major and expect to take the advanced accounting class, this is an area of accounting that you probably shouldn't have to worry about going into too deeply at this point. Trading securities are initially recorded at cost at the time of the investment. However, as time passes, the market value of the securities underlying the investment will change. Typically, accounting rules do not allow companies to adjust the carrying amounts of assets for changes in the market value. For example, when land is acquired, it is recorded at cost. It is subsequently carried on the books at cost indefinitely until such time as the land is disposed of. There is no adjustment for changes in the market value of the land during the time that the company owns it. However, in the case of both trading securities and also for available for sale securities, the change in market value is recorded. The change in market value is recorded as either an unrealized holding gain or an unrealized holding loss, depending on whether the equity securities increased or decreased in value during the period. On December 31st, 2014, Smart Touch Learning reported trading investments of $26,160. The market value of those securities on December 31st, 2014 is only $24,000. Because there has been a change in market value, the change must be recorded. The entry will require, as seen here, a debit to unrealized holding loss, trading securities, for $2,160, and a credit to fair value adjustment trading securities for $2,160. For trading securities, the unrealized holding loss will appear on the income statement and will reduce net income for Smart Touch Learning in the year 2014. The fair value adjustment will be reported in the assets section of Smart Touch Learning's balance sheet. It will be reported with trading investments, and it is treated as a contra asset. Now, for available for sale securities, they are also recorded at cost and subsequently adjusted for changes in market value. However, in the case of available for sale securities, the unrealized holding gain or loss will be reported in equity as part of accumulated other comprehensive income. This means that it will not show up as part of Smart Touch Learning's net income for 2014. At December 31st, 2014, Smart Touch Learning reported available for sale securities of $60,000. The market value of those securities is $64,000, which shows a market gain of $4,000. The entry will record a debit to fair value adjustment available for sale securities for $4,000 and a credit to unrealized holding gain available for sale of $4,000. The debit to fair value adjustment will be treated as an adjunct account and will appear in the assets section of the balance sheet with the related investment account. Exhibit 15.3 in the text explains how market changes are treated for the various types of investments. And as has been typical in some of the other chapters that we've looked at, here is how you calculate a ratio that is used to evaluate some types of investments. And this is the rate of return on total assets. And it's a pretty simple plug-and-play type of ratio.